Welcome to another episode of the Global Investors Podcast. I'm your host, Charles Carillo. Today we have Randy Smith. After a 25-year career in corporate America, Randy turned his focus to real estate investing, becoming a limited partner in 25 passive investments across 12 different operators in 8 different asset classes. Since launching Impact Equity in June of 2022, Randy has helped over 115 investors place $9 million across 17 projects with 6 world-class operators. Randy, thank you so much for being on the show today.
Yeah, thanks so much for having me, Charles. Excited to be here.
That's quite the background, and you definitely have gotten a taste of being a LP investor, a limited partner, and then also being an active investor. So, it's great to have you on the show.
Yeah, glad to be here.
So, give us a little background on yourself, both personally and professionally, over that 25 years prior to, passively investing in real estate, where you got started.
Yeah, so I was a sales guy in corporate America for about 25 years. I spent my last 10 years with American Express. And prior to that, I was with a company called Waste Management for 10 years. So I started in phone sales, moved up to phone sales management, ended up consolidating a number of different call centers, phone sales call centers for various organizations. And then in my last, 8 or 9 years, I went back to carrying the bag again. So got out in the field. I covered territories. I flew to markets. I covered, from Phoenix, I covered Las Vegas in Nevada for a couple of years. I covered Utah. I covered New Mexico, and spent the last 5 or 6 years just covering an Arizona portfolio where I managed small business clients. About halfway through that, my 10 years with American Express, I started investing in single family out of state, trying to do what so many folks when they get into the space. I wanted to buy single family because it seemed easy. And I ended up buying 5 or 6 assets and found pretty quickly that was not going to be something scalable for me. So that's when I jumped into the passive investing space. I figured my time was better spent focusing on my job, because I made very, very good money in my W-2, and leave the investment dollars over to the experts and let them go manage these assets. So that's when I jumped pretty much full speed into passive investing for a couple of years before getting laid off from corporate America.
Oh, wow. Okay. So when you were doing those first deals, those were turnkey single family houses in different markets, I imagine? Is that what they were?
I started with turnkey in Kansas City. And I will just, like, the short story long is that I picked a bad operator and they were anything but turnkey. So being the control freak that I am, I decided that I wanted to have more control of that construction process. So I did the BRRRR strategy on a handful of assets in Atlanta. And my timing was impeccable because the values were going up like skyrockets. And we made a ton of money on those when we finally sold those in June of 22.
Interesting. Yeah, that's definitely a great time frame for buying and selling properties. Definitely selling properties.
Yeah. I literally sold at what I would think is probably the very top of the market. And it was just dumb luck, honestly. I had decided I wanted to shift everything over into passive investing, and that's what we did.
So can you tell us a little bit about your transition from being a passive investor to what you're doing now as an active investor and syndicator?
Yeah. So being a sales guy, I was constantly talking about what I was doing as a passive investor, and a lot of other sales people were coming to me and saying, "Hey, that sounds really interesting. I'd love to get some money in the market as well. How could I partner with you or invest in the type of deals that you are investing in?" And when I was still in my W-2, I actually had a conversation with one operator that I would ultimately end up partnering with. And he talked about this fund of funds structure. And honestly, it just sounded really intimidating. It sounded like it would take a lot more work than what I had the time and resources available. So I kind of just put that on the side. And then when I got laid off, I went back and revisited that conversation with that operator, and they essentially handed me like a business in a box. And they said, this could be a good opportunity for you. You've got a large network, and let's see if it works. If it goes well, then you're off and running. If it doesn't, you really have no exposure because there's no cost to get this thing started. And ultimately I ended up raising just shy of $1 million in like 2 or 3 weeks. And I was off and running. as they say.
So what were some of the skills that you found, skills and knowledge, let's say, that were transferable between being a passive investor to being an active investor? Because there is a few more plates that you're spinning on the active investor side, but a lot of it's pretty similar. I mean, when I'm underwriting a deal as going to be an LP versus being a GP, you're utilizing a lot of the same information and knowledge that you have.
Yeah. So I would say, like, ultimately my superpower is sales. I spent 25 years in sales. What I found in corporate America that I was really good at, understanding complex processes and then really not dumbing down, but being able to share that process in a simplified, easily communicated way. So, in my corporate world, what I would do is I would end up perfecting some process, and then I would become the subject matter expert, and I would teach the rest of the team and the rest of the organization how to go out and do this thing. So essentially, that's what I did in passive investing. I went out and spent a couple of years figuring it out. And then after I refined my process, I was able to easily explain that process to other people. And they were people that were in my network. So they already knew, like, and trusted me. And it was just a very simple marriage at that point to move forward.
Interesting. So can you give us like a little overview of your firm today? I mean, what is your investment strategy and your criteria for investing alongside your investors?
Yeah. So it's evolved quite a bit. I will tell you, my due diligence process on that first passive investment was, I listened to a podcast and I liked the guy and he had a big long beard, so I trusted him. We'll just say that without saying who he is. I think you probably know who that is. So that's evolved quite a bit. Today, we focus almost exclusively on multifamily value add. That buy box has evolved and changed quite a bit over the years, but I like working with operators that have, call it 300 million plus in AUM. These are groups that have been in the space for, I will say, more than 5 to 7 years, because I'm looking for folks that didn't start in the huge, growth that happened in late 2015 plus. So I'm looking for groups that have track record of, 10 or 15 years, of course, multiple exits. And probably more importantly than anything, I want to work with groups that their current portfolio is not struggling. So there were a ton of folks that bought a lot of assets back in 18, 19, 20, 21, where those assets are really struggling now. And I am doing my best to find the operators that either one, were sitting on the sidelines during that time period, or two, were kind of going against the grain and getting, fixed rate debt, long-term fixed rate debt during that time. Because the people that had the floating rate debt, they're the ones that are struggling today.
Right. For sure.
Do you have money sitting in the stock market and you're worried about it? Or worse, you have money sitting at the bank, not keeping up with inflation? My name is Charles Carillo, founder and managing partner of Harborside Partners, and since 2006, I've been investing my money and my family's money into income-producing properties. These are real assets, real properties with real addresses that produce real cash flow. At Harborside Partners, we provide passive investors who love real estate with a turnkey investing solution. If you want to put your money to work in real estate but can't find deals, don't have the time to get funding, and the last thing that productive people want to do is manage real estate. We find the deals, we fund the deals, and we manage the tenants, the termites, and the properties. Partner with us at investwithharborside.com. That's investwithharborside.com. Go to investwithharborside.com. If you love real estate, you like the idea of passive income, and believe that income-producing properties will appreciate over time, go to investwithharborside.com. That's investwithharborside.com.
How do you verify that beforehand? I mean, there's so much information you can get from an operator, but without finding their passive investors yourself, which would be very difficult. How do you verify that these people are checking those boxes that you just mentioned?
Yeah, well, I think first of all, you mentioned a really good point, like finding people that have already invested with it, and not just asking those operators, who are some of your investors that I can talk to, because everybody's got 2 or 3 buddies that they can forward and they'll tell you whatever you want. So more importantly, I find operators from other passive investors that have been investing with them for 6 to 8 to 10 years plus. And I'm very, very fortunate to be a part of a very, very large passive investing community through GoBundance, which is just high net worth entrepreneurs that invest very, very heavily in the space. So more often than not, I'm getting referred to to operators by people that have been investing with them for many, many years. Okay. Now, to go one step further in my due diligence, my general conversation will be, tell me about your track record. How many deals do you currently own? How many have gone full cycle? And then after I know how many they're currently managing, I just simply ask them for their most recent investor updates. And if they've got 30 assets and they give me 10, then I say, where are the other 20? Right. And, those, seeing those investor updates, whether they're quarterly or monthly, and whether they provide financials or don't provide financials, that can tell me 90% of what I'm trying to uncover about the existing portfolio.
Yeah. That's definitely a lot of information there that is really helpful. The financials is a big thing, and also the just the communication. I one time was at a conference years back, and they're on stage, and they said, who's on the list of different real estate syndicators, and everybody raises their hand, and then who's passively invested with one of them, and then who'd like to have more communication with that active syndicator they have, and pretty much everybody's hand was still up. So it's definitely a lacking thing that hasn't changed in years. That was pre-COVID. I mean, it still hasn't changed, where people want more information, even if they don't respond to your emails or anything like that. The more information, the better. And I feel that they know they're on top of it now. And that's going to make it easier for your investors too. I find it, because now they're not reaching out to our team, right, for an update on everything. Whereas, hey, here's everything. If you have questions, follow up with me. And they're just going to go through and find out what they feel is most important. And then if they have any questions, they can respond. But that's kind of what I've seen with working with syndicators, being a passive investor as well, and being an active syndicator.
Yeah, no, I would agree. I think regular cadence with investor updates is really important. The level of the financials that they share, I think, is really telling of the professionalism of that group, and just the transparency to have. What do they say? Bad news should travel much faster than good news, and that's not always the case. Because those are hard conversations to have when things aren't going as planned, but it's important that they do have it.
It's also in those instances, I've found it with speaking to syndicators, and I said, if you just, even though it's not what you're doing right now is not going completely what your performer was, which it never really does per se, you know what I mean? It's above or below. But the thing though is that more communication is going to even this out a lot easier, right? Because people are coming to you for updates. If you just provided some updates, no matter what kind of progress you're having or what's happening, positive and negative, they know it, and they're going to feel, and it's also a trust issue too. If I'm getting a lot of bad information, a lot of bad news, or I'm getting, I would like that rather than no news. So I have some idea what's happening. And then also some sort of proactive strategy of like what we're doing to move this to where closer to what's supposed to be happening. You know what I mean?
Exactly.
But, they dropped the ball by just having the telephone that, there's no information, you know what I mean? Quiet telephone that comes off, and then you're like, everybody else working with investors is left holding the bag in the sense of, well, how do we know what's going on?
Yeah. Yeah. I had, I kind of learned that lesson in corporate America. We had executive vice president that would do BRRRRs with us. So, business unit reviews on a quarterly basis. And I think it was his whole purpose in life to come in and find the one rock that wasn't uncovered and just tear you apart on it. And after going through those for a couple of years, I basically learned that my goal when he came in would be to come in and tell him, here's everything that's going wrong. Like literally, I want you to know everything. And from there, I'm going to tell you what we're going to do to make it right. And, I will tell you some of the most successful BRRRR reviews I ever did were those where he just sat there with a smile on his face and said, there's nothing that I can dig into because you shared it all. So, and I think it was a good lesson to learn that many, many people do not figure that out at any point in their career.
Yeah, no, that's definitely a great example of what it is, because I found when I'm speaking with investors and you provide enough information, you don't hear back from them. You always wonder, what's going on. But then when they reach back out, you will hear something that it was our fault, on our team's fault, that we didn't provide enough information. So now it's like, okay, so let's put out these updates more often. Let's make them a little bit more detailed. Let's make sure they understand all the terms that we're using too in these really high level, we throw around terms, but in normal, just speaking with other people in the business, and you're like, you know what, I should we should really dumb this down just a little bit so people understand. Because no one's going to be like, no one that's getting an update is going to be like, well, this is not the right, you know what I mean? They're going to say it's much easier to understand, right? How many people are full-time in the business? That's why they're coming and partnering with you. You know what I mean? So we talked a lot about finding operators and vetting them. Now let's talk about, you've invested in over 30 syndications. How has your underwriting evolved over that time from just liking someone on a podcast to where you are now, which seems to be a little bit more thorough?
Yeah. So it's, ultimately today, my due diligence checklist is like 110 different data points that I go through. And it's everything from, entry exit cap rates, a lot around. I think the number one risk is with debt these days. So I really like to get an understanding of what's going on with debt, how the estimates for insurance and taxes are come up with, because some of those are some of the biggest surprises that, at least up until the last couple of years, a lot of people were just putting the same numbers in over and over and over again without getting new estimates on those. Oh goodness, I'm trying to think through the list. A big piece is like digging into those investor updates and finding out what's really going on with the current assets and digging into those to see like why did your performer read this compared to what you're actually performing. What we saw is a lot of people were doing exits and getting really great returns on the back end because of cap rate expansion, but their NOI improvement didn't actually match what their performer was. So they could still be providing 2 or 3x equity multiples and not even growing NOI. So why was that? If they were doing a value add plan and they said they're going to renovate 100 units and they only did 7, what happened? So as cap rates are expanding, that NOI improvement and that execution of the business plan is critically important. So people that aren't able to execute on their value add plans, they're getting crushed right now. So really digging into those type of details and seeing why that is.
How does a kind of a market review down to almost like the neighborhood of the asset go for you, in the sense of like, when they say here, this is where the address of the property is, yourself, high level, the first 5-10 minutes when you're looking into that, what are the things that you're really looking into, that you want to see that around a property, or that you want to see with some of the comparables, something like this?
Yeah. So I like to use the strategy where big, large corporate dollars are spending dollars. Then that's usually a good sense, give you a good sense as to what's going on in the market. So if you see Starbucks popping up around, if you see nice new retails, actually that might be a little bit different with some of the changes in the leadership going on at Starbucks and kind of their growth trajectory. But looking at those types of things are important. You can go to Trulia and take a look at crime stats, which I think are really important. You can go to, apartments.com and start looking at reviews to understand what's going on at the asset level. Ultimately, I like to drive properties or have somebody drive properties to give me a true sense and feel, because there's just nothing can beat the, driving a property when the sun's going down to get a feel for what's going on at that asset after dark. So yeah, there's a number of different metrics. I use city data for a lot of trending for population and demographics, those types of things.
Yeah. No, I think what I always say, like, to Starbucks is just, obviously you have people that are paying $6 for sugary coffee near you. It's something that it's a huge plus, and the amount of time and money they put into it. It's rare. I don't remember the last time I saw it that you see a Starbucks going into an underperforming neighborhood. So maybe they're out there, but it's something that's really not that much. And I think that just adds to a whole benefit for people that are, going to be renting from you. You know what I mean? So,
well, and it's interesting too. I mentioned kind of the change in direction of Starbucks. That was a strategy that worked really well for a lot of years, but new leadership in Starbucks over the last 5 years or so, they were starting to go into some of these more challenging markets. And they're now starting to pull back in those markets as well. So, I think, the Starbucks strategy will start to be more and more accurate in the coming years, because they're really trying to go back to their own roots where they were only in the best and growing market. So,
yeah. And obviously that's worked best for them. And that's one of the things, but just having any type of corporate dollars around there, and, there's nothing wrong with independent businesses, but when you start seeing, larger Fortune 500 companies coming in to where you are. There's a lot of research behind it, and it's something that's showing you that you're on the upswing, or you have something that's not going to be going backwards for the most part, right? That's what I found. So in the past, this could be on your deals that you've invested into. I mean, you've done a lot of them, but it also could be on deals maybe when you were vetting other operators. So when they've lost money or deals have underperformed, I mean, what are you seeing are some common traits between those deals? And we understand mainly, the debt structure is a big one, and obviously people not seeing insurance/inflation coming. But are there any other common traits maybe you've seen between those deals?
Yeah, I think probably the biggest one is early on, I kind of fell into the same trend that everybody was, is I only wanted to invest with people that had in-house property management. What I've learned is that property management needs to be vetted, whether it's in-house or third party. And quite often it can actually make more sense to have the best in market third party property manager than bringing it in-house with an inexperienced asset manager or property management company. So, where I see a lot of deals that really struggle is where either one, their in-house property management is not skilled and trained and have the experience, or two, they're not managing the property managers at the level that they should. And I will tell you that I've had operators that will constantly go to, they're always blaming the property manager for what's going on. And at some point, it's the leadership team of the syndication group that's not managing the manager correctly. And ultimately, the buck stops there. So if they've had 2 or 3 different property managers over the course of, X amount of years, sometimes the picker is the problem, not, who they're picking, right?
No, it makes perfect sense. I think there is a huge thing, because I always ask people that come on the show that have, they're vertically integrated type people, firms, and there's not much money that's made in the property management, right? And it always surprised me is that, I said to myself, I would never become a property manager. I feel that you can make more money if you were starting instead of starting a property management company for your properties, like starting like an HVAC company or plumbing, right? These things that are extremely, you pay a lot of money for when you see the bottom lines of what you pay out to these vendors. It's a lot more than what you're paying to make a measly little percentage on this. And it's a thankless. I've self-managed my own properties for 6 years. It's a lot of work. And I just find it that, I'd rather go in with an operator that says, okay, this is our 7th deal in this market and we have 6 deals already with this property management firm. We already have 1,000 units with them. And you're like, this is rinse and repeat. Like, I'm just piggybacking onto success. And the chances of me losing money are a lot less than if we had, so years back, just not to go on a whole tangent, we had a deal we bought in 2019 or something, or 2020. And a couple of partners wanted to do their own management company, and we voted against it. We said, no, we have really good property management in the area, stuff like that. And it was something that we're happy we did, right? But it was also one of those things is that if it went a different way, you don't know what you're getting, like you said. You know what I mean? Are you buying a property management company, or are you starting it yourself? I mean, it's very difficult to find the boots on the ground people for the property managers that are going to be very good. I mean, that's the whole problem between it. You know what I mean? Finding a good handyman. I mean, all these different parts that make up a property management company. So it's something that we voted against having our partners do it vertically integrated, and they didn't with our deals. I think they've done it with other deals and other operators since, but it's just something that I agree totally with what you're saying, that the vertical integration thing sounds great, but when people say, oh, we're doing it to save money or something like this, I kind of, you know what I mean? It's just kind of like, nah, that's not.
Yeah.
It's more control. I mean, you can get on the calls with them all the time. I get so many financials we get from property managers. I know exactly who's renting, who's not, because we'll handle a lot of the marketing. So I get those Excel spreadsheets that are coming in showing me why people didn't rent, why they didn't. You can have a lot of control with third-party managers. So I'm a little hesitant when people use that, but maybe, it seems like you're on the same page.
I would agree with you wholeheartedly too. It sounds like you're really involved with those as well, which is great. And I'm sure your investors really appreciate that as well.
So over the years, since you've made the transition into being an active manager, what have you found other than, raising money? That's kind of like what your firm really based on. But what have you found to be maybe your biggest challenge in this process of becoming more of an active investor? I imagine you still have passive investments in real estate, but kind of what does that look like?
Yeah. So biggest challenges that I'm running into today. I'm really having a hard time finding deals and finding opportunities that make it through my due diligence process. As almost exclusive capital raiser, if I don't have a deal, I'm looking for a deal, or I'm sitting pretty stagnant. So I've made some shifts in what I'm doing with the business to kind of decrease my dependence on deal flow for new deals. And I'm starting to do a lot of coaching and consulting around capital raising, which has actually kind of taken me kind of full circle with what I did, where, in the W-2, I got good at something and then taught people how to do it. I did that with passive investing. Now I'm doing that with capital raising as well. And it gives me the ability to help vet potential partners to raise capital with, in my fund to fund structure as well, where I get 6, 8, or 12 weeks with somebody and I can truly feel whether they're going to be good partners for me or not, because we spend dozens of hours together throughout that different coaching. So, that's been a really big challenge, is trying to find good deals, good operators that make it through, potentially like my too stringent of due diligence process at this point. Other challenges, just kind of silly operational things like, finding good banks to work with that like the structures that I use, setting up the systems and the tools to scale and streamline and create the best investor experience. We're seeing increased expenses with taxes, with systems and tools and in software applications, just like everybody else is. And those need to be covered by the funds, which impact investor returns as well. So, similar experiences, I think, that probably all small business owners are experiencing today.
No, it's great that you're saying about branching off and finding a different way of kind of monetizing your knowledge in your business. And I think when I'd speak to passive investors initially and they'd be like, oh, are you full-time in the business, or asking questions about that? And now as I passively invest, it's not a question I really ask per se, because I found out that some of the best passive investments I've made have been with small groups. The people are very well seasoned. They have money and they do deals as they need them, right? As they come about, right? They're not as they need them. That's the wrong terminology. As they come up. So it might be 1 this year. It might be 2 next year. They have other investments. They have something else that might be going on, maybe within real estate or something like that. But I like that because I know when I'm getting deals, they're not like coming after me for an acquisition fee only, right? These are they're going through the whole process. And I think investors, after maybe being burnt or going through maybe less than ideal passive investments, they start seeing them and they go, okay, this is what I want. I want something that goes through all these things, and they're not just a acquisition machine, right? Type, acquisition fee kind of machine syndicator that's just putting out deals, churning them out to kind of pay their overhead. That's you never want to be on the investing side of that.
Yeah, no, absolutely. And you kind of hit on such a great point where, I'm spending the very large majority of my time vetting new potential operators, because some of the other earlier partners that I work with, some of their current portfolio is struggling. So I'm choosing not to do deals with them until their portfolio gets cleaned out. But then you've got this challenge where it's like you meet somebody new, they make it through your due diligence, but you don't have 2, 3, 5 years experience with those people. And I think it's really easy for anybody to show up for a Zoom meeting or a phone call or a lunch or meet at a conference and present well. But it's truly how are people going to show up when things get hard, when things get difficult? How are they going to perform then? So, it's a challenging position to be in right now where, 5 years ago, you could go through 20 questions and solve 90% of the challenges. Finding those good operators, those needles in a haystack, I think are, ultimately that's what keeps me up at night. That's what, is constantly on my mind, is finding that next deal. I went through a vetting process with an operator over the last few weeks or so. Team referred to me very strong by a number of different investors. But at the end of the day, I had to step away from that And I feel bad. I spent hours and hours and hours with this group going through the vetting process, and I had to tell them the reason why I'm not moving forward. And people's feathers get ruffled, they get upset. But at the end of the day, my number one priority is preserving investor capital. So if there's any reason not to move forward, it's better to walk away from that deal than moving forward with uncertainty.
Yeah. No, that can be tough. And obviously after you look back on all the time and money you've spent, reviewing and, underwriting and checking but it has to happen. I mean, it's just one of those things, like you said, it's a little different now than it was like 10, 15 years ago. And I know you were saying before, like looking for people that have a track record 10, 15 years. And a lot of the syndicators that are doing it now haven't been around that long as syndicators, but you will find groups that I found, maybe we've been syndicating for 6 years. However, I've been a passive investor for, 18 years or whatever it might be. You know what I mean? Not passive investor. I'm sorry. Maybe investing on my own for 18 years with my own multifamily. And you're like, okay, that's like checking that box there because you're just bringing in the investors. I got that. That's an easier thing to fix than like the whole business of buying properties, right? So it's a whole different thing. So Randy, as we're kind of like finishing up here, what are some of the main factors contributing to your success over the years, from professionally what you were before as a W-2 to what you're doing now with your firm?
Yeah, gosh, that's an interview question that I haven't heard for years and years. It's hard. It's kind of that thing where, like, how do you identify top performers and what traits are they? And there's, like the only kind of metric, or trait that I can ever point to is this idea of grit. And, Angela Duckworth wrote a book on it. It's fantastic. If you've not read it, really good. But it's what differentiates what I think average to mediocre performers to top performers. And it's hard to even define what it is, but it's that when you're coming up to challenges, when you're having struggles, when, it's Friday and it's late and you're tired and you're exhausted, like, do you do 2 more reps? Do you do 10 more reps? Do you push through and kind of push through that wall that you're running into? And, I think that's the only thing that I can explain. It's always what differentiated the best sales people from the mediocre. It's what I'm seeing in the entrepreneur space. It's what I saw in my clients. Like that ability to charge through and solve the problem, no matter what comes at you. And that is something I aspire towards and something I try to constantly bring into my day-to-day activities. So, I think that, and then again, kind of going back to that other piece, like the ability to take really complex ideas and share them in an easily understandable way. I think that can be really, really powerful.
It's a lot of great information. One thing it kind of reminds me of is that I was reading something years back of somebody that went training with Evander Holyfield, the world-class boxer. And he was saying that, they're in the gym and they're pushing through the reps. And the guy's like, oh man, like I'm at 9 or whatever. And he's like, you got to finish. He's like, and he got yelled at by Evander. Evander was like, that's the difference between a person just going to the gym and someone that's a world-class athlete, pushing through and doing more than you have. And when no one's looking, you know what I mean? Doing those extra reps. And I think couldn't be better well said, Randy.
Yeah. It's funny. Just earlier this week, I did a post on LinkedIn the other day, actually today, Monday night. I'm exhausted. Both my wife and I were sick for the last 2 weeks. There was a networking event and I did not want to go. But I got my butt in the car and I drove 45 minutes to get there. And, like literally out of the 200 people that were in the room, I connected with 2 people, but one is going to be a potential coaching client and another is potentially bringing a deal to me that I can do with my own investment dollars. So, I'm really glad I showed up, and that seems to be the scenario every single time. When you just push through and continue to show up.
I think my dad told me 90%, right? Showing up. That's what it is to success. It's actually really true. What do you know? So
yeah, imagine that.
Randy, how can our listeners learn more about you and your business?
Yeah. So impactequity.net is my website. I spend a ton of time on LinkedIn. So if you want to DM me, that's a really good way to get me. And then finally, I've got a podcast myself called The Gentle Art of Crushing It, where we interview operators and very highly skilled passive investors. So those are one of the best ways to find me.
Thank you so much for coming on today, Randy. We'll put all those links to the show notes, and looking forward to connecting with you here in the near future.
Hi guys, it's Charles from the Global Investors Podcast. I hope you enjoyed the show. If you're interested in getting involved with real estate, but you don't know where to begin, set up a free 30-minute strategy call with me at schedulecharles.com. That's schedulecharles.com. Thank you.
Nothing in this episode should be considered specific, personal, or professional advice. Any investment opportunities mentioned on this podcast are limited to accredited investors. Any investments will only be made with proper disclosure, subscription documentation, and are subject to all applicable laws. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice. Opinions of guests are their own. Information is not guaranteed. All investment strategies have the potential for profit or loss. The host is operating on behalf of Syndication Superstars LLC exclusively.